For the first time ever, electric vehicle sales globally have surpassed the 10 million vehicles mark in 2022. A total of 14% of all new cars sold were electric, up from around 9% in 2021 and less than 5% in 2020. With China still leading in terms of EV sales as a percentage of total passenger vehicle sales and in terms of total number of EVs on the road. But with new energy, climate and industrial policy regulations and incentives in both the US and the EU, how's the EV outlook shaping up? And what are the hurdles that still face the EV industry? Are mining, battery manufacturing and charging network capacities keeping up? And what are the latest trends in battery chemistries? I'm very happy to discuss these questions and more with my guest, Anna Marie Baisden, the Head of Autos and Infrastructure Research at BMI, part of Fitch Group. Anna Marie, thanks for coming on the show. Let me start with this question here. EV penetration in major developed markets such as China, EU and the US are always referenced in many reports, but how are EVs faring in the developing markets? And which of these markets specifically do you expect to see an acceleration in terms of EV sales growth in the next couple of years?
It's a very good question because, as you said, we talk about global EV sales, but really it is limited to a small number of major markets and most of them being developed at that. So when we're looking at what are the next emerging markets that are good for growth, we're looking at markets that have similar characteristics to the likes of China, EU, US. So we're looking for those markets that have good coordinated supportive policy in terms of supporting EVs. And what we see when we look at the different markets that we cover is that there are different ways of doing that and different ways of and different priorities as well for different markets. So we're forecasting 30% growth for the next 2 years in Latin America in terms of EV sales. And the way they are addressing it is through public transport. So not everyone in these markets can afford EVs themselves. So there is a coordinated plan across a number of countries in that region for electric buses. So that's the way they're approaching it. If we look at Southeast Asia, because I think when we talk about Asia, people automatically think about China, South Korea. But if we look at Southeast Asia, Thailand is already a strong automotive producing market. The government has a good track record of targeting specific vehicle segments with investment in order to help them grow. And it's now doing that with electric vehicles and then providing incentives for consumers to buy those locally produced vehicles. Then if we look at Middle East and North Africa, it's different again because you don't have as many manufacturing countries in the region, but you have diversification efforts and smart city projects in markets like Dubai and Saudi Arabia, which is going to drive demand for electric vehicles. Egypt has a national plan to support production of an electric vehicle and also incentivize consumers to buy locally produced vehicles. So we're starting to see standout markets in different regions. And actually something just today that I was told by a colleague in South Africa is that Ethiopia, which doesn't have very high levels of car ownership at all, is making electric vehicles much cheaper to import than other vehicles so that people will skip ahead straight to electric vehicles, very much like people did with cell phones. You know, they skipped having a landline altogether and went straight to having a cell phone. And that's what we're seeing with electric vehicles. So for emerging markets, it seems to be very different approaches to how they're being supported.
Well, Anna Marie, despite strong expected growth in EV sales globally that you've mentioned, EV penetration might still remain low. What are the key challenges that could put a damper on penetration, you think?
So there are a number of barriers to adoption. Some depend on the market, some are universal. So particularly when we're looking at emerging markets, as we were just talking about, affordability is a big issue. You know, you have some countries where consumers just don't have the level of income required to afford these models. And particularly at the moment, you know, we have a period of high interest rates, high inflation. People are thinking more about their day-to-day living costs than buying new cars. So that's one problem. And also, if it's a market where the government doesn't have the fiscal strength to provide incentives and other forms of support, they can't help out. Another major barrier is the infrastructure. Firstly, we're talking about the actual charging points, having enough of them to alleviate some of that range anxiety, but also the power supply. You know, are you in a country where the power supply is stable enough to be able to charge? You know, again, thinking about my colleagues in South Africa, they have rolling blackouts. That's not helpful if you need to charge an electric vehicle. And then I think another factor is just helping consumers to understand how this can become part of their day-to-day. You know, if you're very much used to just going to a gas station and filling up, suddenly you have to think about how you can fit charging into your schedule. So there are a number of different barriers, but they seem to be the main ones.
The development of a localized EV battery supply chain across the United States and Europe will allow automakers there to gradually reduce supply chain risks. But surely this will increase EV manufacturing costs on the short to the medium term, don't you agree?
Absolutely. These localized plants, as you said, they avoid a number of issues in terms of getting parts to market, but you're not going to benefit from the lower costs that the mostly Asian, mostly Chinese battery plants benefited from in terms of labor costs, in terms of the economies of scale, because we were just relying on a certain number of producers. And so they had massive scale to also benefit from. And I think another thing to bear in mind is it depends how much of the battery supply chain you localize, because even if you find supplies of the metals and minerals that are relatively close to you and you have the battery manufacturing in market or in the region, at the moment there's still a really big proportion. I think we're talking over 90% of the refining of metals and minerals for batteries is still done in China.
Yeah.
Yeah, so you're still going to have the costs of shipping around various parts of batteries at different parts of the process if that isn't addressed as well. And we've seen some moves to bring the refining part more local as well. But at the moment, that's still going to hold things up and add to those costs as well. So we think, you know, we're seeing a lot of investment into batteries, and that should help in terms of economies of scale, but it's still going to be a few years before we start to see it really paying off.
The Inflation Reduction Act, or the IRA, in the United States has a number of provisions with regards to EV manufacturing. Some say these may negatively impact, actually, EV sales in the short to medium term, as the number of EV models that qualify are reduced and the buyer pool is decreased as well. What exactly in the IRA will impact EV sales and how?
Yes, so this is actually a view we share, that some of these provisions will have a negative impact on sales. And it boils down mostly to the local content rules. So from 2023, 50% of the battery components have to be local, which is in the US or markets that have free trade agreements with the US. And so from this year, we've seen that a lot of models are no longer eligible for the tax credits. And so, you know, that puts them at a real competitive disadvantage. From 2024, that local content will increase again to 60%. So, you know, we were just talking about localizing the battery supply chain, and the fact that that could take a few more years to be fully active. So we may see even more models becoming eligible next year. Um, so basically, we're at a really uncertain time, I think, for consumers, in that unless they're really keeping up with the local content of the cars they want to buy, they don't know which models are eligible at which time until they start doing research into that. There's also the fact that prices are fluctuating quite a lot in the US at the moment. There's been a lot of news around Tesla and its price cuts, but also, it's been adjusting some prices upwards on some models as well. So there's a lot of up and down, and consumers don't really, know from one week to the next in some cases what prices will be like. Other brands will then follow suit sometimes. So we can see that having a negative impact as well on the pricing and on consumers just really being uncertain as to how things will be.
We'll come in a few minutes to the matter of pricing, specifically with Tesla, and how's that affecting margins in the industry. But has the industry experienced any new breakthroughs when it comes to battery chemistries? Are you seeing any new alternatives to the lithium-ion batteries arising recently?
Yes, so we know in the background a lot of manufacturers have been working on solid state batteries, which are seen as being a really positive alternative in the fact that they'll be more stable and safer, because we have had issues with car fires with electric cars. But actually, in terms of something ready to come to market that will make a real difference, the BYD Seagull, which is their budget city car, uses sodium ion batteries instead of lithium ion. And that has a number of benefits. It's very good in terms of energy density. It's on a par with the LFP, the lithium iron phosphate battery, in terms of energy density. But sodium is much more abundant than lithium. So there aren't as many concerns over supplies, over having enough supplies. It's also positive in terms of cost. And, that's why they can start this off at a price of $11,000. And that's going to have a real positive impact in terms of bringing more people into the EV market with more affordable models, as we talked about affordability being an issue earlier.
You've mentioned range anxiety previously. Range anxiety, which is consistently stated as a barrier for consumers to switch to EVs. So where's the industry nowadays with regards to the average range standard, if we can call it that?
It's actually much better than if you look back to the first Nissan Leafs, for example, that were on the market. You were getting maybe 100 miles maximum. Now the average is around 200 miles, which is around 320 kilometers. Some of the furthest ones will be 300 miles. And what that means is you can basically cover a lot more use cases for electric vehicles. We always used to talk about them as being great for short inner city trips, but not so much for longer distances or for a lot of usage in the day. But now if you're talking about 200 or 300 miles at the extreme case, then you're talking more about people who want to do long commutes or who have to make a lot of trips in a day if that's part of their business. So that has been a real improvement. And also we're hearing about alternatives to charging, such as battery swapping. NIO talked recently, the Chinese brand NIO talked about the popularity of its battery swapping stations because it allows people to get the new battery a lot quicker than if they were waiting to charge. So that's also another alternative that's addressing range anxiety. But in terms of the batteries themselves, we have so much more variety in terms of the battery chemistries, battery sizes, and it means you can really choose something that meets your use case.
How are the auto manufacturers reacting to the growing EV market in 2022 and in 2023? Any latest news with regards to EV target announcements and investments?
Yes, I mean, it feels like every week we hear about new big investments. I think the most interesting one recently has been from Toyota, because despite being one of the biggest car making groups globally, it has really lagged behind in terms of electric vehicles.
It was more on the hydrogen bet, maybe.
Yes, hybrids and hydrogen fuel cells. And the new CEO has talked about having this multi-pronged approach. So still keeping the focus on hybrids and on hydrogen, but also with a bigger push on electric vehicles. So they're looking to launch 10 new vehicles. They're looking for sales of 1.5 million units a year by, I think it's 2026. So they're bringing in much stronger targets to achieve, because I think they realise they've fallen behind. And even some of those brands that have already announced targets, Jaguar Land Rover, for example, here in the UK, they already announced years ago that they wanted to have all of their product range electric by 2030. But just in the last few weeks, they announced investment of £15 billion to help towards that. So this, I mean, the last few years has been unprecedented, I would say, in terms of the amount of investment that we've seen, because car makers are investing not just in the actual cars, but in battery manufacturing. In some cases, they're investing in mining projects. They're investing in component businesses. So we're just seeing unprecedented levels of investment. I think if you think about VW and its battery plant in Canada, you know, that was the biggest investment the Canadian industry has seen. So yes, certainly in terms of announcements recently, where it's still very active.
But this is definitely leading to greater competition. Tesla has repeatedly dropped their prices recently. What does that tell us about competition and that space, competition in that space particularly, and about EV margins moving forward?
Yes, we always knew that this point would come where Tesla would have a lot more competition. You know, we were just waiting for the legacy automakers to bring out more models, because they're used to producing at scale. They're used to producing a number of different models. We expected more startups to come along as well, who saw the Tesla business model. This year is particularly difficult, though, in terms of competition, because we had all the supply shortages over the last year or 18 months. And now that those are starting to ease and supply levels are starting to normalize, we're having more models coming back into the market. And so that in itself is creating more competition as well. I think last year, you know, if you had models to sell, it already gave you a competitive advantage. But now we're having to look at pricing. And that's why we've seen Tesla start cutting prices a lot. Some brands have followed, some haven't. You know, particularly here in Europe, we've seen a lot of the big European companies like Renault, BMW, VW saying they're sticking to a value over volume kind of strategy. They're not going to cut prices. But as you mentioned, this will all come down to margins, because for those that have been cutting their prices, that's going to hurt their margins. For those that have kept them high, they might start to see a drop in sales, particularly later on in the year when a lot of the pent-up demand has already been fulfilled. So that could start hurting them. So when you think about margins, we're already quite fine on electric vehicles, given the amount of investment and money that has to go into them. This is a real concern for, I would say, automakers across the board. I mean, we would see premium brands being better placed in terms of being able to maintain that pricing power, but it's still going to be a concern for all companies.
In light of the growing expectations of increased EV sales, is the mining and battery manufacturing capacity sufficient to cater to this expected demand?
In terms of the battery capacity, I would say we have fewer concerns. as I mentioned earlier, we've seen billions of euros and dollars being invested into battery manufacturing. And that's not just by the battery manufacturers that have traditionally been in the space, but also car makers themselves getting more involved in the battery supply chain. And the thing about them being involved is they know how many they need. So they're working towards their own targets. And in some cases, there are automakers that are looking to supply other companies as well. So they've built that into the intended capacity of these factories. So we wouldn't be so worried about the battery capacity side of things, but certainly on the metals and minerals side, we work very, very closely with our metals and mining analysts using their forecasts for production and looking at reserves. And for nickel in particular, they're saying over the short to medium term, not so much of a problem. From around 2028, though, they expect to see the market going into deficit. So that's where we could see problems, because there are still battery chemistries that are quite popular that are high in nickel, particularly for more premium models. So that would be something to look out for on that side. Lithium, they expect to see ongoing exploration activity supporting production there. So, we hear about, there are concerns about lithium, but at the same time, that is generating exploration. And also they're talking about new techniques and new equipment, which is actually making it more efficient. So that's a plus side for that. But we've also recently heard about new discoveries of lithium reserves in India, for example. So that's also quite heartening that on the lithium side of things, it may not be so bad.
Finally, are charging networks keeping up as well with EV sales growth in the key EV markets? And how are governments addressing the need for greater investments in this area?
It's certainly better than it was, but I think we can still do more. If just thinking about here in the UK, if you think of the number of gas stations, we're still not at that level yet for EV charging points. Although the positive is that you see them in different places to traditional gas stations. So you see them at office parks, you see them at shopping centres. So they can be put in different places. But I think based on the levels of adoption we expect to see, there's still a lot more that can be done. And even in markets like the EU, where there is so much support for green projects in general, there's still more that can be done in a lot of countries. And one of the issues there is we've always talked about this question of who's responsible. Is it the car makers? Is it utilities? Is it the governments? So you really need someone to lead in terms of deciding who's going to do it. And sometimes, and particularly in developed markets, we see a mixture. We see some charging points that are operated by car makers, some that are by utilities. And I think the utilities are getting more and more involved as they see that this could have knock-on effects for the grid, particularly if electric vehicles can start feeding back to the grid as well. And oil companies as well, the oil companies that own some of these gas stations are also getting involved. So that's a positive, but I think there's still a lot more to do. And in terms of what governments can do, I mean, if we look at things like all of the policies the EU has brought out in the last few years, such as the Green Deal and the what we're expecting to be a response to the IRA and the IRA itself, there's a lot of support there for incentives in terms of building infrastructure to try and attract whoever, whether it be the utilities or private companies or car makers, but just to know that there will be incentives there to do it. So that at the moment is the main way of supporting increased infrastructure. And also, if you can engage in projects where, you're building new areas from scratch, smart cities or new housing complexes or something, for example, that's where governments can have a more direct impact as well.
Anna Marie Baisden from BMI, thank you so much for coming on the show.
Thank you.